everyone, this is Mitch Trades with the El Dorado Trade Group, and this is the 7th lesson of our series, Everything That You Need to Know to Trade Stock Options, where today we will be discussing Thinkorswim, the option chain, and what is a stock option contract. Thinkorswim, also known as TOS, is a powerful trading platform and online brokerage service powered by TD Ameritrade. It is a comprehensive solution for stock, options, futures, and forex traders that provides access to real-time market data, advanced charting tools, and an array of customizable indicators and studies. One of the standout features of TOS is advanced charting capabilities. Some traders prefer the charts in TOS over TradingView, and this is a personal preference. I recommend trying both before committing to one or the other, while keeping in mind that using both is what I personally do, and will explain how I do so in a future lesson. TOS also offers over 400 technical indicators, advanced drawing tools, the ability to create custom studies, tools to view stock fundamentals and earnings, scanning tools, and much more that you will find while exploring all it has to offer. Within TOS, or Thinkorswim, you will find the option chain. An option chain is where you will select and view the option contracts that you will be trading. It is a graphical representation of all available options for a particular stock, index, or other underlying asset. Within the TOS platform, the option chain displays all the option contracts that are available for trading, including their strike price, expiration date, and current premium or price per contract. The option chain is an important tool for options traders as it provides valuable information about the underlying asset and the options market. Traders can use the option chain to analyze different option strategies, evaluate the potential risk and reward of a trade, and make informed trading decisions. One of the key features of the TOS option chain is its customization options, which allow traders to view the option chain in a way that best suits their personal needs. For example, traders can choose to display the options by expiration date, strike price, or other criteria. They can also sort and view extra data on the options like implied volatility or the Greeks, which we will be going over in the next lesson, to help them quickly identify attractive trades. Now, like we just discussed, the option chain is what holds all of your option contracts that you can choose to view or trade. A stock option contract is a legal agreement between a buyer and a seller, giving the buyer the right but not the obligation to buy or sell 100 shares of a stock at a specified price, known as the strike price, on or before a specified date, known as the expiration date. The two main types of stock options are called call options and put options. A call option gives the buyer the right to purchase a stock at the strike price, while a put option gives the buyer the right to sell a stock at the strike price. Stock options provide investors and traders with a flexible and cost-effective way to trade stocks, allowing them to take advantage of price movements in the market while limiting their potential losses. For example, by buying a call option, an investor can benefit from a stock's upward price movement without actually having to purchase the stock. Additionally, stock options can be used as a part of a broader investment strategy, such as hedging, to manage risk and protect against losses in the stock market. For example, by purchasing a put option, an investor can protect their portfolio from losses in the event of a downward price movement in the stock market. Remember, when you buy a call option contract, you are betting on the stock to go up. When you buy a put option contract, you are betting on the stock to go down. Within the option chain, the call options can be found on the left side of your screen, and the put options can be found on the right side of your screen. There are three main types of stock option contracts based on their relation to the current market price of the underlying asset or the stock. There are contracts that are at the money, there are contracts that are in the money, and there are also contracts that are out of the money. We will only be covering and focusing on two of these: the contracts that are out of the money and the contracts that are at the money. At the money option contracts is where the strike price is approximately equal to the current market price of the stock. For example, if a stock is trading at $50, an at the money call option would have a strike price of $50. These are the type of contracts that you should aim to trade, and they sit right where the gray meets the purple in your option chain. Anything in purple is in the money. Out of the money option contracts is where the strike price is higher for a call option or lower for a put option than the current market price of the stock. For example, if a stock is trading at $50, an out of the money call option would have a strike price of $60 or higher. Out of the money options are the least expensive of the three types, as they are the least likely to result in a profit at expiration. Another important detail is, since one option contract represents 100 shares of stock, whatever the price of the ask, which is what you will click on to buy the option contract, you must multiply by 100 to find the actual price of what you will pay per contract. One option contract is equal to or represents 100 shares of an underlying stock. When you exercise an option contract, it means that you will either buy or sell 100 shares of the underlying stock for every contract exercised. While we talk about the right to buy or sell shares of a stock in reference to options, that part of it is almost irrelevant in the type of trading that we do, which is called scalping. We buy to open and sell to close seconds or minutes later. That is the sequence that needs to happen in order to get in and out of a stock option contract. I've been trading options personally for a few years, and I've never exercised a contract. That's something you would focus on doing with a much larger account. The easiest way to describe what a stock option contract is, in the context of how we specifically trade it, is think about it like a virtual currency that will either appreciate or depreciate very, very fast while you are in possession of it. Your max loss is whatever you put into the trade, and your potential profit is exponential. So just to show you a really easy kind of example of the process of what happens here, I have a virtual account that I'm going to kind of just roughly explain what's going on. If you weren't following before, basically you get to the option chain in your Thinkorswim by going to the trade tab. And once you click on the trade tab, you're going to see these options, and you want to click on option chain. And usually, most of the time, you're going to be trading expiration dates. That's what these are right here, are expiration dates. And you're going to be trading expiration dates that are basically closest to today's date. This is a virtual account, so we're trading a completely different time. But usually you're going to be trading these expiration dates unless it's the same day expiration as the day of your trade. Then it can get a little bit more dangerous, but even so, you're probably going to be using these expiration dates. So when you click on this expiration date, your option chain pops open, and these options in the purple are in the money. You don't usually trade those because they're way more expensive. Typically, it's said that they are safer to trade, but they definitely are more expensive. So we're going to focus on at the money and out of the money. At the money basically means that you're going to be trading right at where the gray or the black meets the purple right here. This is an at the money contract right here before it turns purple. These are all out of the money contracts. And basically, the idea is, let's say, well, right now in this virtual account, the stock is trading at about 225, right? It's going up right now. It's around 225. Let's say I want to place a bet that the stock is going to go from 225 to 230. I think it's going to go up $5. So I go down here and I find the strike price of 230, and I go over and I'm going to click on the ask. And that's kind of where the buying begins. I'm going to show you a different way to buy these contracts and to set up your Thinkorswim in a future lesson. So I'm not going to go deeper on that part of it right now. But essentially, what's going to happen is I think it's going to get to 230. So I'm going to buy this and I'm going to pay, like I said before, this says $6.90. We're going to times that by 100, meaning we're going to pay $690 per contract. And once I purchase this contract, hopefully the stock price starts moving up. And when it starts moving up, the premium or the price of this contract is also going to go up. And basically, what you want to wait for is for this 230 to work its way up to be at the money or in the money. This is kind of a drastic move. You wouldn't necessarily play this far out of the money. But just for an example, you would essentially wait for this 230 to approach or even enter in the money territory, where the premium, as you can see, is going to go up from $675, $690. It's going to be a few $100s more when you sell it. And that's basically the concept of the option contract. Because when you talk about exercising a contract, and I'll show you what that kind of looks like right here. So I am in Amazon calls right now, 15 of them. So if I right click this, there's an option that says exercise. Like I said, in all cases of the style and type of trading that I personally do, I don't exercise contracts. It's not something I do. But basically that's what the option contract does. Is it gives you the right to buy 100 or to sell 100 shares of the underlying stock for every contract that you personally own. You're not really going to worry about that. You're more so worried about going into your option chain. This is now Amazon. Amazon is trading at 117. I think it's going to pop up to 120. I'm going to buy this option contract for $1,295. And then hopefully it's going to move up. The stock will go up. The price of the premium will go up. And once this hits, let's say for argument's sake, $15 or $1,500, I'm going to sell it for that profit. I'm going to do the same kind of example here, but with Amazon and on the put side. You can see right here, Amazon is trading at around 116, 117. It's in between 116, 117. So let's say I think Amazon is going to go down to 115. I anticipate Amazon moving down. I'm going to go find my 115 strike price. I'm going to go over to the ask, and I'm going to pay $1,165 or $1,165 for this contract. And if the price of Amazon stock goes down to 115, this contract will move into the money. It will gain some value. Let's say, for argument's sake, it goes from $1,150 to $1,450. You would sell the contract and you would have a $300 profit. There are also two golden rules when looking at option contracts to buy on this option chain. There's two things that you need to look for and to consider before purchasing these contracts. One of them is the spread between the bid and the ask. So basically, depending on the order type that you use to purchase or sell these contracts, you can get filled at any point between the bid and the ask that you see. So if the bid-ask spread is 70 cents, then there's going to be a $70, there could be a $70 discrepancy right off the bat. As soon as you buy that contract, you could be down $70. You don't want to do that. So you want to look for contracts with a tight spread. You want to look for contracts where the bid and the ask is 2 cents apart or 5 cents apart. Really, you don't want to focus on contracts with a wide spread. And the second thing that you want to look for and pay attention to is you want to make sure that the open interest and the volume of the contract that you are trading specifically is as high as it can possibly be. So let's say you open up your thinkorswim, you open up your option chain, and you're looking at it, and you see that a specific contract has way more volume and way more open interest than all the other ones, and it's kind of a little bit more out of the money. You might, in some cases, be better off trading that contract because the volume and the open interest is what creates an ease of buying or selling. When a lot of people are trading the same contract, when you click buy and when you click sell, you are very, very likely to get filled and to either get in or out of a contract as quick as you would like to. Once again, this was Mitch Trades from the El Dorado Trade Group. Thanks for watching the 7th video in our series, Everything You Need to Know to Trade Stock Options, where today we discussed thinkorswim, the option chain, and what is a stock option contract. I know that at this point, some of you are probably a little bit lost, but just take in whatever you can. And as we do the future lessons, things will fall into place that will start to make sense as time goes on with the more experience that you get. If you learned anything in this video, please like, comment, and subscribe down below. I hope you have a great rest of your evening. Thanks for watching.